Good evening, everyone. A warm welcome to all the viewers of the webinar of EAC on recent EAC opinions under India's framework. I'm Parul Gupta, Secretary, Expert Advisory Committee, and I'm joined today by CA Dr. Debashish Mitra ji, who is Chairman, Expert Advisory Committee and immediate past President of ICI. Then S.N. Gupta ji, who is Head of Technical Directorate. Then our distinguished speakers, CA Jayant Gokhale ji, CA MP Vijay Kumar ji, and CA Shri Palsha ji. Good evening, everyone, and welcome to all of you. Now, I would invite and request our Chairman, Expert Advisory Committee to express opening remarks.
Thank you very much, Parul, for starting of the program. And good evening, ladies and gentlemen. Let me tell you how happy I am. You can see me smiling because I am there today. The two speakers that we have are speakers of excellent. They represent excellence to many of us. MP Vijay Kumar, they'll be both formally introduced by Gupta ji, our technical director. But let me tell you, MP Vijay Kumar, 6 years I've spent with him in the council. And I was just saying just before the start of this program that to many of us, he represents excellence. So today, we already have crossed 1,000 viewers. So I'm sure, we'll have a record. It's because of people like him, they bring in that reputation of excellence. Jayant Gokhale, he has been there in the council for so many years earlier. Those of us who are a bit of world-timers will know Jayant Gokhale very well. But what really makes him special is that, he served 2 years as the chairman of the Expert Advisory Committee. And those who have worked with Jayant Gokhale, they also know that his technical knowledge is second to none. And the gentleman who is, moderating today's session, Sri Palsha, he is a special invitee to the Expert Advisory Committee and, helping us and very, very active in the deliberations in the Expert Advisory Committee. Now, when I speak to you about the Expert Advisory Committee, and of course, we have seen that, I have told you about the presence of S.N. Gupta and Parul Gupta and the others who are here, Khushbu. When I talk about the Expert Advisory Committee, I go back to 1975, when the Expert Advisory Committee was formed. And in that year, it was, Expert Advisory Committee was formed much later, in the sense that the research committee of the institute was formed in 1950s, then maybe 1955. But Expert Advisory Committee was formed in 1975. Since then, we have come a long way. We have issued more than 1,600 opinions. This year itself, today we had the 15th meeting, Paul? Today was the 15th. Today we had the 15th meeting of the Expert Advisory Committee. We have, given 48 opinions till now, this year. And total number of opinions that we have given since 1975 exceeds 1,600. And what we have done is, we have put all these opinions in a compendium of opinions volume. There are 42 volumes of the compendium of opinions. Those of us who would be very interested, and those of us who are into audit and accounts, the core areas, you would be, I'm sure you are taking full benefit of those opinions that are carried there. We also have a search engine, and which will make it very easy for you to access these opinions. And today, when the meeting was on in the morning, we were discussing that to what extent we can use AI, artificial intelligence, in making it that much more easier, more comfortable for all the viewers to access the opinions that we have got. In the Expert Advisory Committee, many of the opinions, seekers, the querists, they come to us for opinions because, the CAG's office, they have a viewpoint which is different from the viewpoint taken by the company. And because of the CAG's request, they come to us for the opinion. In fact, today I was seeing an opinion which had come to us, in which the CAG said that for the time being, we are, pausing with this, with this finding of ours, till the Expert Advisory Committee comes up with a viewpoint on this. So much is the faith that the users of our opinion has on the Expert Advisory Committee. And let me tell you the debate, the discussion that takes place in the expert advisory committee, both MP Vijay Kumar, Jen Gokhale and Shripal Shah will agree with me, are sometimes, furious. Sometimes, we deliberate, debate, try to come to a conclusion. But at the end of the day, when we give an opinion, I think till now, it is very much respected. Right. So, I welcome all of you. Today, I believe we'll discuss 6 opinions, right?
Yes.
6 opinions. And we have two of the finest minds on accounts and audit, Jan Gokhale and MP Vijay Kumar with us. And of course, we have Shripal Shah, who will be moderating the session. And I hope all of you would be, having a extremely good time listening to this kind of learned professionals that we have. About 3 hours back, I was speaking to the president and vice president of the institute. And I was telling them that today we should touch a record number of viewers. And since we have already exceeded 1,000 at this point of time, I'm sure that today we shall break all records as time progresses. And once again, welcome to this, the webcast that you are having on the opinions that the expert advisory committee has given. And I wish all of you a very, very happy learning. With these words, may I now request the technical director, S.N. Gupta, to kindly introduce the speakers formally.
Thank you, Chairman sir. And thank you, Chairman sir, first of all, for taking EAC to such a tangent where the visibility of EAC has never been before like that. This is the 6th webinar, sir, this year. And this particular initiative has been vastly welcomed by all the stakeholders in the industry. They really take a lot of interest in this webinar. So thank you, Chairman sir, for leading EAC team and guiding us, behind us. Now, I am, sir, very extremely happy also because MP Vijay Kumar ji, Dr. Jan Gokhale ji, the two stalwart of the professions, are there today as a speaker. It will be a great pleasure listening to both of them, who are the top voice of accounting and auditing profession in India. So it's extremely lucky day for all of us to listen to both of them today. CA Jan Gokhale ji has a professional experience of more than 40 years. He served as a Central Council member of ICI for 12 years, from 2001 to 2013. Over the last 2 decades, he has been closely associated with numerous academic activity, including the framework and adoption of accounting standards, many of India's, as well as the standard of auditing as well. He has been chairman of EAC for 2 years in past, and he has also been a member special invitee of committees for many years. He has been a part of various committee board of ICI in one capacity or the other, such as AASB, FRRB, PRB, etc. He has authored 2 publications on taxation, and he has an incredible contribution on the various technical committees. I welcome you, sir. Jan Gokhale, sir, I welcome you. CA Vijay MP Kumar ji has a prolific experience of more than 30 years. He served as a Central Council member of ICI for 6 years, from 2016 to 2022. Currently, he is a member of IFRS Interpretation Committee of International Accounting Standard Board, IFRS Advisory Council, and IFRS for Small and Medium Enterprise Implementation Group. He has been vice chairman of EAC in past, and he has also been associated with various committee board of ICI in one capacity or the other, such as ASB, VSB, DAB, FRRB, Committee on Accounting Standard for Local Body, etc. He has authored more than 10 publications in accounting, auditing, corporate and allied laws, financial reporting, etc. It's always been pleasure, sir, listening to you. So we welcome you, sir. CA Shripal Sahaji, who will be the moderator of the session today. CA Shripal Sahaji has more than 20 years of professional experience in audit, tax and financial field. He is a partner in one of the reputed chartered accountancy firm. He is specialized in conducting statutory audit of various companies, including large public sector undertakings. He has carried out IFRS and India's convergence, transition and implementation for various entities. He is currently a special invitee in the expert advisory committee. I welcome you, sir. With this, I hand over the floor to Shripal ji to take over the proceeding of this webinar. Thank you very much, sir. Over to you, sir.
Yeah, thank you very much for the nice introduction. Thank you, Devashish sir. Thank you, Parulji. So, and very good evening to all the viewers. We would be discussing about six EAC opinions during this seminar. And I'm pretty sure that the attendees would get a lot of insights as to how the committee has dealt with all those opinions and the very intricate issues that are there would be discussed in this seminar. Okay, so I would be narrating the facts of the issues in brief, and thereafter I would be requesting our eminent speakers to deliberate on the same. Right, so let me share the screen. Is the screen visible?
Yeah, it is.
Yeah.
It is.
Okay. So before we begin discussion, one clarification that the views given over here would not necessarily be the views of the ICAI, and when there is a divergence that would be there in any publications of the ICAI and these webinars, then the former would prevail. So the literature that would be given, that would have been there in the publication, would prevail over this the views discussed in this webinar. So coming to the first issue, okay, which is about the accounting treatment of the other income, bank interest on funds invested out of advance received under IND-AS framework. The facts of the case are like this. A company is incorporated and engaged in one and only activity, that is creation of self-constructed asset, high-speed rail. That is the project between two states. The company receives funds as external aided project funds, that is EAP funds, from Ministry of Finance, Ministry of Railways and Government of India against loans to the government from Japan International Cooperation Agency, JICA, to finance the project. The external aided project funds are placed by GOI at the disposal of the company to meet the project expenditure on items eligible to be financed under the loan agreements, since the loans are available on reimbursement basis only to the GOI. At present, the terms and conditions are not finalized between the company and MOF-MOR. Thus, MOF-MOR do not charge any financing cost, borrowing cost on funds released to the company. In the financial statements of the company, the EAP funds have been presented as other financial liabilities at amortized cost under the head financial liabilities non-current. Further, the company is measuring the said financial liabilities at amortized cost. The company places deposits in banks out of these funds received in the form of equity capital and EAP pending utilization for the project, and has been recognized interest on amount of EOP pending disbursement by JICA to the GOI in the statement of profit and loss as other income. The auditor's views are, as per the accounting policy regarding capital work in progress of the company, the income pertaining to construction period and other incidental income such as interest income is adjusted against the expenditure during construction. However, the company, in violation of its accounting policy, has shown interest on EAP fund as its income instead of adjusting the same with the expenditure during construction. Civil. So management's reply to observations of the auditors are, interest income on does not have any kind of nexus with capital work in progress. Interest income in any way does not make any impact on construction activities or cost of construction. Borrowing cost to be capitalized is to be adjusted with the income earned from temporary investment of borrowed funds while the project is still in the stage of construction. Since there are no borrowing costs to be capitalized related to EAP funds, interest income on temporary deployment of funds cannot be reduced from the cost of the property, plant, and equipment. So the queries has sought an opinion of the EAC as to whether accounting treatment of other income being interest income by the company is correct. If not, what should be the treatment in the opinion of the committee as per the applicable IND-AS? If there is any different accounting treatment as compared to treatment done by the company in the financial statements, are these changes to be treated as changes in estimate, accounting policy, or prior period errors? So these are the facts of the case and query posed by the queries. So I would request Jayan sir to deliberate upon the facts of the case and the opinion that has been framed by the EAC committee. Sir, please.
Yes, right, Shripal. Thank you very much. And thank you, Chairman, also for the very gracious words of introduction. Before I get into the subject proper, just a quick couple of lines. One is that the hard work has already been done by the expert advisory committee. We are only trying to convey perhaps the sense and the depth of deliberation that often goes into these opinions. And to start with this case, let me mention the first case looks apparently simple, but invariably when something looks apparently simple, there is a lot of complexity in it as you get into the case. So we will try to give you, both MP Vijay Kumar and myself will try to give you a feel of what is the logic that we try to adopt when we come to some conclusions. And of course, this is what we believe is the best solution. It is possible that sometimes even we could be wrong, but then the opinion of EAC is a good enough shield for every practicing member. So let me plunge into it. The first case study, which is there on your screen, I'll just mention that, the couple of important points, and this is one of the principles that I'll not reiterate later on, that everything that is given in the query needs to be studied with very, very careful reading. So I will highlight a couple of points because sometimes seemingly innocuous statements have got very great significance in the final conclusion. So if you see the second bullet, you will notice that the company has received funds as EAP, but these are funds from Ministry of Finance, Ministry of Railways or Government of India. The loans, if you see the second bullet, loans are to the Government of India from JICA. So technically, the company is not itself borrowing. These are external aided project funds which are placed by the Government of India, that is mentioned in the third bullet, to meet expenditure. But the loan per se from JICA, which has actually given the facility at a very cheap interest, no doubt, but the interest charge is there. On the other hand, so far as the querist is concerned, the terms on which the money has been obtained by the company from the Ministry of Finance or Ministry of Railways are not yet firmly decided upon, and as a consequence, the said ministries are not charging any financial cost or borrowing cost to the company. Now, this is a very important factor when we go into the deliberation, because if you see the query, the question that arises when you interpret the borrowing cost standard, etc., is that it is to be set off against the interest expenses. Now, can there be interest expenses is one fundamental issue which the company has also raised. So let's come to that. So first and foremost, there is no borrowing cost. Then what has been cited is that the income that what happens in connection with construction. So what has been cited by the CNAG is that when operations occur in connection with the construction, these items, the income and, or rather when it is not in connection with the construction, they are to be capitalized. And if you see the last bullet on that first slide, it is mentioning something quite shocking, that as per the accounting policy, regarding capital work in progress, the income pertaining to construction period and other incidental income such as interest is adjusted against the expenditure. This is the policy. The CNAG has gone on to observe that the company, in violation of its accounting policy, has shown interest earned as its income instead of adjusting the same with expenditure. Now, this is the crux of the issue that has arisen over here. Now, when you come to this concept, two things need to be examined. A, whether there is actually some borrowing cost which has been incurred, and secondly, whether that borrowing cost relates to the assets which are under construction. So the first issue that has been raised, and whether at all the company can violate its own accounting policy, that is the third issue that will be seriously under consideration. So the first issue that attention has been drawn to para 21 by the EAC. I'll not go to the paras of the opinion, but very briefly, as I mentioned, when certain operations occur, but these are not relevant to bring the item of PPE to the location and condition necessary for it to be capable of being used by the management as intended, then such item does not result in adjustment to the capital cost. This is a very significant item. In fact, if you see, and why I'm quoting para 21 is that para 21, which has been, of course, quoted by the EAC, it gives the illustration of a car parking. That means if the funds are received and while the construction is going on, certain space is unutilized, the standard itself gives an illustration that the extra ground area that is unoccupied may be used for letting out for car parking and the revenue may be earned. Now, does this revenue in any way result in a reduction in the cost of capital? Suppose they had not given this for car parking, would the cost of construction been any different, or would there be something having a nexus with the cost that is being incurred? And if the answer is no, para 21 of the standard very clearly says, para 21 of AS 16 dealing with property, plant, equipment, it clearly says that in such cases, the income and related expenses are recognized in profit and loss account. Now, two important points to take from there. The income and related expenses are to be taken to profit and loss. So this point one may keep in mind. Then I will also draw attention to the other para which has been sort of referred to in the opinion, that would that be something that, in contradiction, or rather in contradistinction to what has been stated in para 21, if something is going to be adding to the value of the asset by virtue of whatever income you are getting or whatever benefit you are getting, then of course you may capitalize that cost either plus or minus, because minus if it is resulting in a reduction in cost, plus if it is adding to your manufacturing capability, handling capability. So para 11 of the same standard says that. But in this given case, why I am drawing your attention, in this given case, the receipt of interest on fixed deposit does not add, alter, or increase the capacity of the assets, whatever are being built. So the high-speed railway or whatever is being constructed does not in any way get affected on whether you keep the deposits or not. Therefore, the querist has emphasized that it will not make any difference, and therefore it has not treated it as an adjustment to cost, and it has treated it as income. Another sort of supplementary argument that the querist has taken, which of course EAC has not found it acceptable, and rightly so, that one of the things is that they say that the standard requires that interest should be adjusted. That means interest earning should be adjusted against borrowing cost. But if I don't have borrowing cost, which is the case over here, does that mean that therefore my income does not require adjustment with the capital? Again, while EAC has not explicitly ruled on the matter because that is not directly relevant, but the indication is that a zero cost is also zero cost. So you may have income which could go to adjusting the cost of the asset, provided, of course, it has some nexus to the asset. In this case, of course, that argument not being relevant has not been proceeded further by the EAC. And then the other interesting part is, while the statement has been made that the policy followed is not in concurrence with the, or not in agreement with the stated accounting policy, actually the EAC has also taken note that if you read the policy carefully, what they have said is, and if I may just request that we go to the previous page of the PPT, that what is stated as the policy regarding capital work in progress, income pertaining to construction period and other incidental income. Now, incidental means incidental to the construction of the asset. As we already discussed, if some interest income is not related to the asset per se, it does not get covered by the policy. So this aspect also has weighed with the expert advisory committee in coming to the conclusion that this interest income has no nexus with the capital assets under construction. However, there is an interesting twist that has been given that, and this is again mentioned in the facts of the case, that the financial statements of the company reflect the external aided project funds as, and this wording is important, other financial liability at amortized cost. Now, when one looks at the question, actually, this has not been very much emphasized or perhaps not understood or appreciated by the querist, which has led to some of the complexities that they have stated when pointing out the liability, saying that it is three characteristics. A, it's a financial liability. B, it is a long-term liability. It is not it's a non-current liability. So therefore, under Ind AS, the requirement of unwinding of the charges of that, etc. And although there is no interest, the EAC has rightly pointed out that there could be a transaction cost attached to that funds. There would be some initial transaction cost, expenses incurred in order to secure the finance, etc., which as per the Ind AS has to be amortized, as per IFRS, as per Ind AS. Therefore, it would not be correct to presume that merely because Ministry of Finance does not charge me anything, it would not be correct to presume that therefore there is no transaction cost and therefore there is no amortization involved in the financial liability, which is a non-current liability. So these three factors need to be kept very much in mind. And therefore, if I take just hypothetically that if there is a liability of whatever, so many crores of rupees, 1 lakh crore, I think is the figure. Against that, if my transaction cost is there, then that cost, let's say it is 10,000 crore rupees. That 10,000 crore or 1,000 crore, if I take it, if it is to be spread over 20 years, I would take 1/20th or some in net realizable value impact of that and amortize it over the period. That would be my intrinsic cost for the liability. And against that intrinsic cost, my interest can undoubtedly be set off because it is not something that would adjust against my capital cost, but it would certainly adjust against my transaction cost. So that is what the EAC has actually opined in conclusion. It is very interesting that sometimes, there is a phrase that be careful what you wish for or what you ask for. When framing a query, when you actually ask a very open-ended question to EAC saying, is the accounting treatment right? Perhaps if that had not been asked, perhaps that would not have been answered. But having asked that question, that is the accounting treatment in regard to my liabilities correct? The answer is no. And EAC has given that example that you need to do that amortization. Against that amortization, the stand that interest should not be adjusted against the capital while it is correct. The interest should be adjusted against any cost arising out of amortization of transaction. That is part one. Then, and they have also spelled out that you have to use the effective interest method as has been prescribed in the Ind AS. You have to compute your inherent transaction cost by taking that into consideration as per Ind AS 23. And then take the net income, which has to be taken to the credit of profit and loss account. So to that extent, while taking it in income is correct, but taking it at gross figure is not correct. You have to net it out against the intrinsic cost. That is the second part of the answer. And the third part, that before I come to whether it's an error or not, the other part which the EAC has also addressed is that when you have taken this concept that it has to be adjusted, there is nothing wrong with the policy. The policy is correct. This matter is not covered by the stated policy which has been cited. However, it has rightly been pointed out by the EAC that perhaps there needs to be greater clarity in the statement of the policy, because that will bring better information to the reader, and therefore the company has agreed in the correspondence with EAC that they will restate, although that is not a change in policy, they will restate the policy to make it more clear. So you will understand the nuances, how careful one has to be. And then finally, since they had asked whether this results in an error or is the policy wrong, the EAC has also concluded by saying that while there is no error in policy, but it is an error in understanding and application of the standard, and therefore it would be an error within the meaning of Ind AS. And since by the time the opinion has come, 1 or maybe 2 years have already passed, it would have to be treated as an error, as a item that has to be adjusted in accordance with Ind AS 8, and perhaps your previous year statements also would require restatement to that extent. And accordingly, the interest income net of the transaction cost element would be reflected as income, which is correct. Means in broad terms, the company has done just that, but they have taken simply the aggregate figure. It has to be netted out and restated to the extent that it impacts the earlier year also. So that broadly is the opinion. I think I have given an overview. If MP Vijay Kumar has anything further to say on that, you're most welcome, or Sripal, anybody else wishes to say something.
Thanks, Jain Bhai. I think after such a detailed articulation, I'm not sure if there is something which I can add. Maybe I'd just like to highlight one part of the whole discussion. As you rightly mentioned, I think you mentioned it 2-3 times, that these opinions or the queries look simple. They look simple. And sometimes when we ask, we do not visualize the situation. You actually end up with something else coming out of the way that particular issue needs to be seen. I just want to highlight one portion here, what the committee has decided, or rather sort of clarifying in this case, is that the EAP amount which is there is a financial liability. And that financial liability, there's a fair value attached through a effective interest rate method. Consequently, there is a implied interest sitting there, which is being treated as a borrowing cost, So I think for many of the listeners here, and later for the preparers when they read the opinion, I think this is a very, what should I say, landmark kind of opinion, which probably that's not the way many people would have seen it. So this is basically an advance which has been received. And being a financial liability, there is that implied interest which we are treating as borrowing cost. If you look at Ind AS 23, while the borrowing cost is defined and the treatment of borrowing cost is defined, we don't have a specific definition, I'm quoting out of memory, on what constitutes borrowing, borrowing. So is every financial liability a borrowing? So those are some open questions are there, but I'm sure the committee has deliberated that. And I'm sure for many of the preparers, this is an item which they need to evaluate well. And many of them would not have applied it the way the EAC has analyzed it. Does not mean it is an error. I think it's basically the way you apply the standard. So people need to now recognize EAC's opinion on this and decide the next steps forward. Those are my 2 cents on this, Jain Bhai.
Thank you, Jain sir and MP sir, for excellent articulation on the subject. So, see, if we read the facts of the case, there are good arguments that have been put forward by the queries, right? the beauty of the query lies that, see, there is always some merit in the case that has been referred to the EAC, correct? But when it is through the intense discussion and research that EAC comes up to a conclusion whether to accept or negate the arguments put forward by the queries, right? And this EAC opinion is interesting from the perspective that there is always a considerable debate on what is directly attributable and what is incidental operational activities, right? EAC has brought out very well what is directly attributable, right? And this interest income being incidental in nature, apparently it seems that this cannot be adjusted against borrowing costs or cannot be capitalized or adjusted against the cost of an asset. So if we read that part in isolation, it appears that whatever treatment that the company or the entity has followed seems correct. But EAC has gone one step ahead, and it has, gone to the basics. Since this particular item has been classified as a financial liability by an entity, naturally, the effective interest rate method would naturally apply. And there would be some element of borrowing cost would come into play. So whatever interest income that the company would generate needs to be appropriated or adjusted against those borrowing costs first, and whatever surplus is left out can be treated as another income. And if we see the opinion, there is a beautiful interplay that has been brought in the opinion between the Ind AS 16, Ind AS 1, Ind AS 23, and Ind AS 107 also. So at many times, entities ignore disclosure requirements that are there under Ind AS 107. So committee has very explicitly brought out the disclosure requirements under Ind AS 107 as well. So as Jain sir, you rightly mentioned that it appears that the query is little simple, but the details, devil lies in the details, and I would say that the beauty lies in the deliberation, right? So if there is nothing further to add, shall I move to next?
No, I'll just add one point, sir. Of course, it is a very general point, but it will have application. Since we are discussing the manner of interpretation, I thought I must also mention, for benefit of all listeners, that there is always published at the EAC opinion side that every opinion is based on the facts of the case. So it is not like a court precedent that because this opinion has said, you simply blindly apply it somewhere else. Point one. Point two, very often, as Sripal has just mentioned, it is these niceties that are there, which are in the facts of the case, that you will have to consider, and therefore EAC, despite its very detailed deliberations, may not always give a clear-cut answer, yes or no, as you will see in some of the answers, and that is only because in each fact, each professional has to apply to his respective facts. So sometimes there is a clean answer which applies to these facts. It may not be simply lifted and applied, dumped onto some other facts. So I thought, let me just mention this for clarity. It will apply to all the discussion that we have, but there can be finer nuances, changes in different facts, and people may sometimes feel that EAC has not, been consistent or something. So I thought this should be mentioned as a precautionary thing. That's it, sir.
Very true. Very true, sir. Thank you. Thank you, sir. Thank you for the addition to the issue. So I would move to the next issue. So this is in respect of accounting treatment of pre-project expenses for which fund approval is pending under Ind AS framework. The facts of the case are like this. The company is a subsidiary of Oil Industry and Development Board, OIDB. The company constructed strategic crude oil storages caverns at 3 locations. Capital costs for construction of caverns were provided by OIDB, against which the shares were allotted to OIDB. All these caverns are fully operational. Day-to-day expenditure for operation and maintenance are incurred by the company out of the grants reimbursement given by Ministry of Petroleum and Natural Gas, MOPNG, Government of India, GOI. The company was mandated to construct additional storage at other two locations in phase 2 through capital grant. For study of suitability and feasibility of location under phase 2 project, the company had to incur some pre-project expenses. As per directions from the MOPNG, funds were provided by parent organization, OIDB, 100% shareholder of the company, during the period from March 2019 to March 2022. The funds received from the OIDB were for expenses for pre-project activity, which are revenue in nature. However, during placement of order and execution of pre-project activities, the cost got escalated against the sanctioned amount. Against the escalated cost, bills have been received till the end of the financial year 2021-22, but the disbursement could be done only to the tune of funds sanctioned and disbursed by OIDB. Balance payment for which bills are in hand could not be made in the absence of the funds. The company requested additional funds from controlling ministry MOPNG. In a subsequent development, the parent company has provided shortfall of funds on the directions of the MOPNG. As per company's accounting policy, grant received from shareholders are recognized in profit or loss on a systematic basis over the periods in which the company recognizes expenses, the related costs for which the grants are intended to compensate. On the basis of the same, the grant received by the company from its shareholder, OIDB, is treated as income in the statement of profit and loss. Income recognized on accrual basis, that is to the extent of expenditure incurred, irrespective of actual amount of grant received. Correspondingly, amount of expenditure incurred out of that grant is shown as expenses in the statement of profit and loss. Accounting policy with respect to revenue grant received from shareholders was followed for the sanction and disbursed grant for OIDB. However, liability for the unbilled invoices in hand could not be provided in the financials in the absence of sanction of funds from the MOPNG GOI. Auditor has stated that not providing of liability in the books of account has resulted into understatement of liabilities and understatement of loss to the extent. So the query that has been posed to EAC is with regard to whether or not the company's accounting treatment for not making provision for expenses incurred in the books of account in the absence of fund source and not providing for liability for the same is in books of account was in order. If not, what accounting disclosure methodology would have been adopted by the company with respect to such transaction and or situation? So I would request MPV sir to deliberate upon this query. Please, sir.
Thank you, Shripal, for introducing the query. Sincere thanks to Debashish Dada and the committee for the invite to be part of this webinar. Happy to share the floor with very, very senior and respected member Jayant Kokleji, whose contribution to the profession has been immense. Greetings to all the members who are present here, and pleasure being with you on the panel, Shripal. So as far as this query is concerned, it basically talks about a parent body providing funds for an entity for construction of what are called caverns, which are the underground storage tanks for the unrefined oil. Typically, the process is there are some funds which are sanctioned and those funds are made available. And the sanctions are based on plans and estimates. So here is a case for the financial year ended March 2022. For March 2022, the total expenditure incurred was about 21.2 crores approximately, as against which 19 crores is the amount which has been sanctioned and made available by the parent organization. The balance amount has not been sanctioned because the project has run an escalation. So it goes through its due process of approval. And as per the facts which are available in the subsequent period, the same has got approved and made available. The question is for the year ended March 22. since those funds have not been sanctioned, this entity will obviously not be in a position to make payments to its vendors, So question is, should they recognize the liability? Should they recognize the liability as at March 22? That's the query which we have in front of us for this pre-project expenses which are being incurred. And this particular non-accounting of the 2.2 crores, whatever amount is there, is essentially because of the uncertainty about the receipt of funds and the source of funds. So if you were to apply the logic on the context of receivables, where there is an uncertainty, you would not recognize, or if recognized, you would make a provision. So here is a case where the organization has incurred a liability, but there is an uncertainty relating to the availability of funds for paying that particular liability, the way it is, the organization is structured. And for that liability, obviously, there are expenses which are pre-project expenses. As all of you are aware, during the capitalization period, the pre-project expenses go through the income statement and they get capitalized subject to the conditions which are there. Let's look at technical literature. Just a couple of references to the relevant technical literature. To begin with, we have Ind AS 1, which mandates or which requires an entity to recognize all items of income and expense which pertain to that period. So here there are pre-project expense incurred for that particular period. So Ind AS 1 has clarity on the fact that anything relating to that period, you need to recognize the same. Second is the technical literature relating to liability provisions. So when it comes to provisions, we have trade payables and liabilities, we have accruals, and then there are provisions. So for all of these, there is guidance. Trade payables, no uncertainty, you recognize. Accruals, some limited uncertainty in measurement, you accrue and recognize. For provisions, there is a significant uncertainty in its estimation, but eventually you have to estimate and recognize if there is a liability, So you don't defer recognition of a liability because there is uncertainty in the measurement part of it. And for this, the supporting literature is the conceptual framework, which defines liability as a present obligation of an entity to transfer an economic resource as a result of past events. So the key criteria for a liability to exist are: one, the entity should have an obligation. So look at the facts of the case and tick mark. Does the entity have an obligation? Second, does it have an obligation to transfer an economic resource? The third is it an obligation which is there now because of the past events which have happened? So considering this technical literature which I just articulated, Ind AS 1, Ind AS 37, and conceptual framework relating to the liability. So looking at all of these three harmoniously, it is important that the liability of 2.2 crores, even though there is the 2.2 crores there is no uncertainty there. The uncertainty is only with reference to the source of fund to pay that liability. On that 2.2 crore being an expenditure and that it is a liability of the entity, there is no uncertainty. So an uncertainty related to a source does not give you a choice of not recognizing that expense and liability. So considering all these aspects, the conclusion of the committee, and I am obviously in sync with that, is that the expenditure and the liability needs to be recognized. The expenditure obviously will go through income statement, but since it is pre-project in nature, it's likely to qualify for capitalization and it will get independently capitalized. And given the fact that in the past they have not recognized it this way, if we were to rectify it now, subject to the other requirements of Ind AS 8, including materiality, you have to apply the principles of Ind AS 8, whether it's an error, and then do the accounting suitably. So that's, in a summary, the views of the committee on this particular issue. Over to Jayant Bhai to add his thoughts.
Yeah, if I may, there is, one line of argument, it has not been mentioned expressly over there, but which I could sort of gather is the implicit reasoning that they have, that since the grant, one of the policies that is mentioned, is recognized in the year in which the related expenditure is incurred, the logic seems to be that since I don't know how to treat the grant, it is possible that maybe in 23, when the clarity comes as to whether this is being received as a grant or this is being received as a loan, at that point of time, if it is a loan, then it will offset one against the other as a capital cost. If it's a grant, it will be reflected in my income. And on matching principles, I should therefore carry forward this amount and not book it in the current year. I entirely agree with you and, of course, the expert advisory committee that the definition of liability does not vest or rest upon the point of recognition of income. Undoubtedly, it is possible that in the subsequent year, the government may say that this is a grant. Now the expenditure, the policy says, I would have recognized the expenditure in proportion to the grant that I have recognized. But unfortunately, the standard in recognition of liability cannot be and is not relaxed in that manner, and that is why I entirely agree with the summation that you gave. But this apparently seems to be the implicit reasoning that the company has sort of adopted, although not appropriate according to me also. So that's how the EAC seems to have looked at it, and I concur with their finding.
Yeah. No, Jayant, actually, thanks for pointing it out. I think the key aspect here is there are two legs to the transaction. One is incurring the expenditure and liability. Second is the source of funds for retiring that liability. I think both the legs need to be seen separately. So I think you rightly articulated. The company seems to have got to a view that the source of funding and the liability both are one and the same. They've tried to mix the same. I think it needs to be seen in a segregated manner. Both need to be seen separately. I think I agree with you, Jayant Bhai, on that. Over to you, Shishir.
You, sir, you have very well explained all the points that are set out in the opinion. And you have brought out the beautiful interconnection between Ind AS 1, Ind AS 37. So the fundamental characteristics of the Ind AS is that they are interconnected. You cannot ignore one standard. And what EAC does that when there is a particular guidance available, which is relevant to the specific issue, the EAC invariably refers to that particular Ind AS 1. When no guidance is available in the very relevant Ind AS, EAC goes and see whether any guidance is available under other Ind AS. So whether other Ind AS contains any similar or related issue. If there is no such guidance available in other Ind AS as well, then EAC goes and refer to conceptual framework. Right? The conceptual framework basically contains the very critical concepts and definitions as such. It is settled position that conceptual framework is not an Ind AS basically. It just assists the financial statement preparers to understand and interpret the Ind AS better. So the committee has gone to the very basics and refer the conceptual framework over here and see what is the definition of the liability. And it goes on the guidance that has been given in the conceptual framework. Right. So in this case, since there is a contractual obligation, the committee has dealt with the issue accordingly and opined accordingly. Right. So shall I move to the next issue, which is also very intricate and interesting issue?
Shripal, since you touched on the conceptual framework, with your permission, I'll just add one important point on the conceptual framework, using the opportunity that we have so many members attending here. Conceptual framework is basically meant for two things. Primarily, it is meant for the standard setter, that is for the institute, which is the accounting standard board. So, and in our country, the institute is the standard setting body. The notification happens in Companies Act through a consultative process with a body called NFRA. But otherwise, by Act also, standard setting responsibility is only that of the institute. So conceptual framework, part 1, primarily is applicable only to the standard setters when they are drafting a standard. It tells this is the framework in which you have to prepare, part 1. Part 2, it is applicable for preparers and users, part 2. It is, it's not appropriate to use the word secondary, but it is the next one. It's the next level for preparers and users. And for preparers, it is meant in two situations, A and B. A, wherever standards give a choice or an accounting policy choice, let's say revaluation method versus cost method, trade date versus settlement date, wherever choices are there, the conceptual framework is to be used by the preparer to arrive at what is the best of the choices which they need to use. It's not a blind choice. They need to get guided by conceptual framework in selecting which of the options is a better one. There are several standards in Ind AS/IFRS where options are given, and they're given for a reason because these are principle-based standards. So this is A. B is preparer. B, preparer. There could be some situations for which there is no standard available. There's no guidance available. Those cases, the preparer can develop an accounting policy, keeping in mind the conceptual framework. So this is how the entire conceptual framework operates. I just thought I'll take this opportunity to articulate it for the members at large.
Thank you, sir, for valuable insights. So coming to the next issue, timing of capitalization of property, plant and equipment, PP and depreciation thereon. The facts of the case are, state government decided to set up lignite-based mining cum thermal power plant. A company, here I have to refer to as the company, was incorporated as a joint venture company between R Limited, which is an undertaking of state government, and J Limited, wherein R Limited holds 51% shares and J Limited holds 49% shares. The company is engaged in mining of lignite and supplying it to J Limited. The tender for setting up 6 MTPA lignite handling system from J Mines to J Limited on engineering, procurement and construction EPC basis to size and transport lignite mine from mines was floated on 27 December 2017. On the basis of technical evaluation of bids and price quoted by bidders, a letter of award LOA was issued in favor of F Limited, while later dated 1st November 2018. F Limited submitted its comments on the letter of award, while later dated 8th November 2018. Subsequently, the contract agreement between the company and F Limited was signed on 4th January 2019. As per clause 3 of LOA, the effective date of the contract shall be the date of receipt of LOA. And as per clause 5 of LOA, the commissioning of all equipment under the scope of work shall be completed within 15 months from the effective date of the contract for such extended time as may be allowed in terms of the tender document. Accordingly, as per LOA, the date of commissioning of the project is to be considered as 31st January 2020. The company has started crushing and transportation of lignite through one stream with effect from 30th September 2020 and from 19th December 2020, both the streams were operative. And the company has started to dispatch entire lignite through lignite handling system. The project was declared commissioned on 31st December 2020 after time extension. The performance guarantee test was demonstrated successfully, achieving all the parameters as defined in the tender conditions on 23rd February 2021. Taking over of the lignite handling system was done on 1st March 2021. The company has accordingly capitalized the lignite handling system with effect from 1st March 2021. That is from the date of taking over. That is when the risk and rewards of the plant were transferred to the company and has charged the depreciation accordingly. The company has capitalized and charged depreciation with effect from 1st March 2021. That is the date of taking over when the risk and rewards of the plant were transferred to the company. Whereas the auditor expressed their opinion to charge the depreciation with effect from 1st January 2021. That is the date of commissioning. The query that has been posed to the EAC is whether the company is correct in capitalizing and charging of depreciation on the lignite handling system with effect from 1st March 2021. That is the date of taking over, or as per the views of the auditor, the company should capitalize the lignite handling system with effect from 1st January 21. That is the date of commissioning. So I would request Jayant sir to deliberate further on the query. Jayant sir, please.
Yes, thank you. Thank you, Shripal. So let's move straight to the query. As always, when a matter reaches EAC, there are numerous nuances that one has to look at. So since this is a query that relates to the timing of the date of capitalization and depreciation, and basically the argument between the two seems to be between the January 1st or March 1st. But let's look at, and that is how the EAC actually looks at. So they don't go by, that if you ask whether A is right or B is right, EAC is never bound by the concept that either answer A or B. If we feel that it is neither, we could still come to a different conclusion in the expert advisory committee. So let's look at all the various dates that are there. And when we look at all of them, let us finally look at what the answer is, because this is typically one answer where they have said that it depends on the judgment of the company. But before we come to that, for those of you who want to sort of particularly take note, I have listed out, just for simplicity, I have listed out all the dates which are relevant. Some not relevant but mentioned. So as has been mentioned in the PPT also, the letter of award is 1st November. I have referred to that as A in my own notings. Then there is contract agreement, which is 4th January 2019. Now we are looking at two very old dates. The reason I'm mentioning it is that somewhere there is a date for completion, which is 15 months from that date. So whether that plays a role or not, we will come to that. So A is 1st November 2018. That is letter of award. Technically, the contract period is 15 months from the date of letter of award. But the contract is finally signed a couple of months thereafter. That is, after November, it is November and December pass by. January, the letter of award, January 2019, it has been signed. Now, technically, 15 months from there would have been the date of completion. Of course, there is a proviso that you can have extension, and that apparently seems to have been done as per the facts of the case. Then, the third segment is reached when crushing and transportation have begun for one stream on 30th September 2020. So that has also been mentioned in the facts of the case. So as has been mentioned in the second last bullet, the 15-month period has been mentioned. Then, of course, is the actual crushing which has begun on 30th September 2020 in regard to one, and 19 December 2020 in regard to the second one, after which both streams are operational. Now, note that although 19 December that was done, the project was declared as commissioned on 31st December 2020. So, declaration of commissioning is a separate thing. Having declared that, the dates of completion are given in a certificate, because that also is often a part of the agreement, because warranties and other things kick off from certain agreed upon dates as per the contract, and therefore there is a commissioning certificate. Now, if you see 30th September 2020, crushing actually started. The first stream, they started the certificate of commissioning mentions 16th October 2020. The second stream is mentioned as 31st December, although actually the utilization started from 19 December. Then comes the important date of 23rd February 21, where performance guarantee test was demonstrated successfully. Now, it is possible, the facts don't mention it. There are times, and I have seen in practice, that sometimes the performance guarantee test is started maybe on, say, 1st of January. There are various fine tunings to be done under the contract, and certain parameters have to be achieved in order for that to be acceptable. So, final demonstration which has been found acceptable has taken place on 23rd February. So, it is not to say that there was nothing done up to 23rd February. It's that this is the acceptable level. And then on 1st March 21, there is an actual handing over of the lignite handling system by the company concerned to the querist. Now, this is a whole range of dates that actually one needs to consider. So, I have tried to take it as the EAC would look at it although I was never part of any of these opinions, I must say, and that is why I can express my views with an open mind. But EAC, I'm sure, has looked at each of these dates, but since they have not been asked, that deliberation has not been sort of documented. But I can tell you that when this issue is addressed, every one of these would have been considered. So the first answer is very simple, that even though it was possibly in January 2020 that the 15-month period got over, or February 2020, it has no relevance to the point of time of capitalization and depreciation, even though contract provided for that. So that is the first part. The second interesting part is that when we come to the property plant equipment standard, Ind AS 16, it says that if there is a certain part of the plant, a component of the plant overall that you have placed an order from, if it is capable of functioning independently, then it is functioning as the management had asked for, and therefore you are entitled to, or rather required to, capitalize it at that point of time. Now, why I'm mentioning this is two streams. One in September or October, sometime this was done, 16th October. The certificate was there, and 30th September, the actual crushing and transportation on stream 1 had already started. The question that would then be addressed is that should the company start by capitalizing this part of the plant on, say, 30th September or 22nd October when the certificate has been given, 16th October when the certificate has been given? Apparently, that is not the case, for the reason that if you see the wording used in the standard, it is said that it should be functioning in the manner that the management expected, capable of operating in the manner intended by the management. So when do you consider, and these wordings are very critical, when do you consider that an asset is complete? It is only when it is capable of operating in the manner intended by management. So management would not have said that, okay, I presume that is the implicit part of the contract, that suppose you do stream 1 and for some reason you are not able to do stream 2, we will pay you only 60% of the contract. If that was a condition, then perhaps you can say that there is a ground to bifurcate the two and capitalize them separately. But in this case, the contract is one of totality, from what I gather. And therefore, to say that merely because one stream started operating in September would not suffice, or October, would not suffice to say that the asset has been constructed in the manner and is capable of operating in the manner intended by the management. And therefore, it would not be proper to say, and there are figures which show that significant amount of that material was in fact being, lignite was in fact being transferred from October to the plant. The statistics have been given. Still, one would not be in a position to capitalize on 22nd October, which is the date on which the certificate has been given, commissioning certificate. 16th October is the date of commencement. Commissioning certificate is given on 22nd January 2021. So these are again different dates. Actual functioning, commissioning certificate. Again, slightly different. They have their own nuances. Then coming further, after that, a performance guarantee test was demonstrated on 23rd February 2021. So that is one more date for consideration. Now here one can say that, see, the contract provided that they have to also perform the performance guarantee test and demonstrate to the satisfaction of the client, just as we have in software, you have user acceptance testing, UAT. So similarly for plants of this nature, there is a performance guarantee test that was completed on 23rd February. And finally, on 1st March, the handing over of the lignite handling system was done. Now, all these options, if you consider one by a process of elimination, I would say very clearly that first two dates of the letter of authority, letter of award and contract date is not relevant except for determining the period of completion, which again is hypothetical because plants may not necessarily be completed. Yes, there could be clauses of penalty that could be activated if you don't complete it, whether that penalty would affect by if penalty is actually paid by the contractor and received, whether it would go to adjust the cost of the capitalized asset. Answer would probably be yes, but we'll not get into hypothetical issues. Then the declared date of commissioning on 31st December and commissioning certificate on 22nd January. Now, these are two possible dates. But the most important aspect which seems to be missing over here is that the contract that is specified is laying some degree of emphasis, from what I can gather, is laying emphasis on various performance tests to be conducted, because later in the query you will see that it included, they've mentioned which tests are included, and that's there in the PPT also. I think on the next page, it is saying that the scope of work involves setting up of the lignite handling system and included tests being conducted such as no load test, load test, commissioning test, reliability test, performance guarantee test. All these tests were to be conducted by F Limited. Therefore, it seems implicit that until such tests are conducted, you can't really say that the contract, that means the equipment, is capable of operating in the manner intended by the management, because for all you know, in even one of these tests, if there is a significant failure which is not acceptable to the management, then the management would not be responsible for taking over that plant until these errors, deficiencies in performance, etc., are set right. Therefore, in my view, of course, I'll come to the answer of the expert advisory committee, but in my view, this is a very significant test which you cannot ignore. And therefore, even though the commissioning dates and the certificate of commissioning dates, etc., are prior to this, I would not give too much importance to those dates. This is my view, not stated by the EAC, because this seems to be a significant item within the contract. So that is one possibility that one needs to address. And also that there is another argument which of course has been mentioned in the expert advisory committee opinion, that whether this prior to the guarantee testing, whether one can say it is complete or not, is also influenced by the fact, if you see para 16 and 17 of Ind AS 16, and which has been reproduced in the opinion, it is bringing out a very nice aspect that costs which are to be capitalized, which are given in the definition of what costs are to be capitalized, it says that costs of testing to see whether the asset is functioning properly are entitled to be capitalized because they are prior to completion. Now, if you say that performance testing is a test and it falls within this para 17E, I think it is, then obviously it is something prior to the completion, because anything after completion is not permitted to be capitalized. So by inference, one can say that para 17 gives an indication when read with para 16 that until the completion of the testing, you cannot come to a conclusion that the asset is capable of functioning in the manner expected by management. There is another reference, para 20 of Ind AS 16. It says that recognition of cost ceases when the asset actually is applied. Now, if cost of testing is prior to the recognition of cost ceasing, it is implicit that cost of testing constitutes part of the continued development of the asset, even though to a layman it may appear that the asset is now ready for use. So that is the test that one needs to keep in mind. Finally, keeping all these factors into consideration, the committee, and this is why I gave that earlier mention, not to sort of link it only with this opinion, but to all opinions. In the conclusion, if you see to this query, the EAC has given a very restrained answer saying that as per requirements of Ind AS 16, it is a matter of technological assessment and judgment, which the company should exercise itself in its specific facts and circumstances. Why is that? Because there is every possibility that the understanding that you and I would have by referring to certain selective facts may not necessarily agree with the facts on the ground. And these are very specialized plants, so each one could have a different sort of expectation of management. Therefore, while personally, if you ask me, I would be more inclined, given the facts, I'm putting all the caveats possible, I would be more inclined to go with the 1st March because that is the date when actually the handing over takes place. And usually my experience has been that contracts of this nature are largely governed by the formal handover. However, there could be a case as has been, that is why the EAC has been very cautious. You could make out a case in certain facts saying that commissioning certificate 22nd January 21 could be a possible date, declared date of commissioning 31st December, and therefore that could be one date which is being considered actually by the auditor. So there are arguments on all sides. However, I think the reference to para 16, 17 and 20 in Ind AS 16 are very crucial. The terms of the contract have to be read, and therefore on a technical evaluation both of the technology that is being used as also a proper interpretation of the terms of the contract, that all risks and rewards are vested only upon the handing over, what is the word used? They say that certificate or actual handover. So certificate of completion, commissioning is one stage, but actual handing over is equally important. This would have to be judged on the reading of the contract, and I think that is why the EAC has been fairly guarded in giving a specific date. They have only expressed the principles that would govern, and I believe that is rightly done. And therefore, that's what I would only urge that, whenever somebody is listening to this, therefore, don't go by a quick, we tend, and I personally also am subject to that. Suddenly, when you read a problem, you think the answer is very simple and you try to jump to that conclusion and then post facto try to justify what conclusion you have reached. But EAC consists of very cool minds. Very often they prevent you from jumping to conclusions. They will consider every option that is available in the manner that I have listed out, thanks to my years in the EAC. And then you come to a very reasoned and careful conclusion is what the EAC has given. I fully support that view.
Maybe, sir, you'd like to add something to it?
I have nothing to add, actually. It's so beautifully articulated. I was just absorbing his articulation. I think one of the key messages which he said at the start and at the end is that not to get guided by should it be A or B, there can be a C. So I think that's what is very important. And in this case, that C is pretty clearly evident in this final opinion which is given.
No, thank you, Jain sir. Very neatly explained. There are a lot many dates to remember in this particular opinion. I categorically remember that when this draft opinion was circulated amongst us for the comments, I literally had to jot down all the dates. It's very difficult to grasp all those. But you have, sir, you have very beautifully brought out that it is the intended use that is most relevant and not the extent of use, right? So when the asset is ready for the intended use, then the quantum of the output is not relevant at all. One may come and argue that since I am operating then the lesser than the desired capacity, say for example 5%, 10% capacity, then I can say that the asset is not ready for my intended use. So the committee has brought out very categorically that while the committee has acknowledged that this is a technological assessment that is, management's and prerogative management's assessment, but it is the operational capacity, operational capability of a particular asset that is most relevant over here. So it has been very beautifully explained by you as well, sir. Thank you so much. So should I move to next issue on hand?
Yes, yes.
Okay. Yeah, this is with respect to presentation of amounts received under channel financing facility as per the requirements of the Schedule 3 to the Companies Act 2013. The facts of the case are like this. The company deals with the consumer durables, which include domestic appliances, kitchen appliances, and electric fans. The company sells its products to dealers and distributors, D&D, channel partners, with an average credit period of 30 days. It has been evaluated and concluded that the sales meet the criteria for revenue recognition prescribed in India's 115. No interest is charged by the company for the credit period of 30 days. If the payment is not made within this period, the company charges overdue interest to the customers. If the D&D makes payment to the company within 1 to 3 days from the date of sale, the concerned D&D is eligible for cash discount of 2%. In many cases, the D&D lack availability of working capital banking limits available with them and therefore are not able to make upfront payment to the company. To bridge this gap and get upfront cash against its sales, the company has entered into a channel financing arrangement with banks, which shall provide working capital limits to D&Ds, ensuring upfront payments to the company. Key points of the arrangement are as follows. This arrangement for sanction of the working capital limits credit facilities entered into between the bank and D&D. It is not mandatory for all D&D to enter into an arrangement, and the D&D may, at its own discretion and requirement, apply to bank for this credit facility. Arrangement letter is duly signed by authorized person of D&D and authorized person of bank. The credit limit assignment by bank to D&D is solely at the discretion of the bank. This is usually decided considering various parameters such as number of years of D&D dealing with the company, historical value of transactions between D&D and the company, basis due diligence process of each bank, basis credit appraisal process of each bank. The limit sanction have the following hypothecation security from D&D. Primary, against all stocks, receivables, and current assets of the D&D. Collateral, first loss default guarantee, FLDG, by the company. Guarantee of D&D. The credit facility can be cancelled, reduced at the discretion of the bank. Interest on the credit facility is computed on daily balances, duly compounded, and is payable on monthly basis by D&D to bank. All other charges, namely facility fee, inspection charges, documentation charges, penal charges, etc., are obligations of D&D and are liable to be paid as per the terms of arrangement between bank and D&D. In this process, company is not a party to credit arrangement entered into between bank and DND and only supports bank with the recommendation letter to bank before sanction of credit facility with DND. Defaults by DND in repayment of principal interest on due date triggers the following. As assets of the DND are hypothecated and guarantees given by DND, the first recovery process is initiated by bank against DND. If DND is unable to honor above, bank has a right to call upon the company for recovery of sums due, since the company has given FLDG to the bank in this arrangement. The FLDG and the channel financing facility are two separate arrangements. In this FLDG arrangement, DND is not a party to the same. Below are the key points in arrangement entered into between banks and the company for FLDG. The channel financing facility arrangement is entered between bank and the company. The arrangement specifies maximum limit for which finance can be given by bank to DND on recommendation of the company. The terms and documentation required by the company to comply with the post-sanction of channel financing facility majorly include relevant documents, namely invoice copy, DND financing arrangement, etc., to be submitted by bank to initiate disbursement of funds by banks. Sorry, to be submitted by company to bank to initiate disbursement of funds by bank. The terms and conditions applicable to bank and the company in case of default by DND to honor the payment to bank on the due date. The company has evaluated the complete arrangement based on the requirements of Ind AS 109 related to derecognition of the financial assets and believes that the FLDG arrangement means that the company has retained all significant risk and rewards of the receivables from DND. Hence, it cannot derecognize the receivables. Rather, it needs to recognize the amount received from the bank under the arrangement as an obligation in the balance sheet. An issue arises on presentation of above amount received from banks by company. As per the guidance note on Division 2 Ind AS Schedule 3 to the Companies Act 2013, revised January 2022, loans payable on demand should be treated as part of current borrowings. Current borrowings will include all loans payable within a period of 12 months from the date of the loan. In the case of current borrowings, the period and amount of defaults existing as at the date of the balance sheet should be disclosed item-wise. The company has not interpreted monies received from bank as borrowings on account of the following considerations. The credit limit arrangement for assigning working capital limits to DND is between bank and DND. This arrangement letter is duly signed by authorized person of DND and authorized person of bank. The credit limit assignment by bank to DND is solely at the discretion of the bank and is decided basis the parameters as assessed under the norms of the bank. The interest, principal, and other charges as applicable are obligations of DND. The recovery process or reasonable steps in the case of default are firstly performed against DND. The bank at its discretion can cancel, reduce the credit limit. Companies' drawing powers, borrowing powers are not blocked for outstanding channel finance balances. The company has merely given FLDG. The company at this stage has no obligation to make payment to the bank. Such an obligation will arise only if there is a default on the part of the DND and the bank invokes the FLDG. Thus, ideally, it is like a contingent liability for the company. It needs to be presented as a financial liability only due to the specific requirements of Ind AS 109. Above transaction cannot be interpreted as borrowings as bank is making payment on behalf of dealers. Once the DND opt out for the credit limit arrangement, DND cannot request the bank to make payment at the end of the usual credit period of 30 days allowed by the company. DND have hypothecated their assets against facility. Though this arrangement may prima facie indicate recourse factoring, the key differentiation remains that these facilities are open on creditworthiness of DND and not that of company. And the company is only guaranteeing the facility credit limit to enable DND to manage working capital requirements. The company has not interpreted the monies received as loan repayable on demand on account of the following considerations. Channel financing facility given by bank to the company is an independent program and DND is not a party to this arrangement. In the company's view, both the credit limit arrangement between bank and DND and the channel financing facility between bank and the company should be seen and accounted for separately. Banks have a right to raise the demand on the company only in case of default by DND, which is a contingent event. So the query is like this: whether the amount received from the banks by the company under the channel financing facility shall be shown under other current financial liability or current borrowings as per the presentation and disclosure requirements of Schedule 3 to the Companies Act 2013. So I would request MPV sir to deliberate further on the issue. Sir.
Yeah, thank you, Shripal. It's fairly long
Query, yeah.
long facts. The query is small, but the
Query small, yeah.
facts are pretty long. I think we just have less than 30 minutes and 3 queries to go. So what I'll do is I'll briefly summarize the query and get to the way the committee has evaluated this and arrived at the opinion. As you introduced, there are 3 parties here: company, dealer, and the bank. So the arrangement is company is supplying goods to the dealer. Dealers obviously have tight working capital. They're eligible for a cash discount if they pay it within 2-3 days time. Almost all dealers will not be in a position to avail that discount because working capital tightness. So in the overall interest of business growth, the company enables through a bank an arrangement wherein the banks can independently assess the creditworthiness of the dealer, understand volume of transactions, security available, and give credit limits to the dealers. It is at the choice of dealer whether they want to have that credit limit or not. It is their choice. It is their choice. So the arrangement between bank and the dealer is an independent arrangement, which has been facilitated by the company more as an introduction. And one of the key terms of this credit arrangement between the bank and the dealer is that if the dealer does not pay on the due date to the bank, then the company has given a guarantee that they will pay the amount. So there's a financial guarantee which is there, which arises in the event of a default. This is one arrangement. This second arrangement is between the bank and the company, who is the supplier of goods. And in this arrangement, dealer is nowhere in picture. It's an arrangement between company and the bank. So in respect of the goods which have been supplied, where there is a receivable outstanding, the bank says, I've given them some credit limit. I know I'll get the money in 90 days. And I will collect the charges from them. You give them a 2% discount. And I will give you the money now itself. It's a channel financing facility. This question is limited only to accounting in the books of company. We are not talking about dealer at all. We are not talking about dealer. Accounting in the books of the company. In company books, what are the transactions? First, there is supply of goods resulting in a receivable. Then from the bank, a sum of money has been received. After considering the discount, sum of money has been received by the company. And this money is not the borrowing of the company. It is not the borrowing of the company. On the due date, if the dealer has paid the bank on the right time, then this receivable gets derecognized and this financing facility will get knocked off. If due date there is a default, given the fact that company has stood guarantee to the first arrangement, the company has to pay the bank and independently pursue its recovery options from the dealer. So this is broadly the two arrangements which are there. The question here is limited to only accounting in the books of company, and more so it is limited only to how the presentation should be done as per Schedule 3. Given the fact it is 90 days, it is current liability. Question is, should it come under borrowings or should it come under other financial liabilities? That's the question which is there. So in this particular facts of the case, the committee has rightly excluded or rather considered and said that, look, the borrowing arrangement is only with the dealer or distributor. So whatever the company has received is not a borrowing program. It's not part of the borrowing program. And the facts which you read out, Shripal, I think the facts also say that when the bank assesses the working capital limits of the company, they do not consider this as part of the borrowings. It is not carved out as a sublimit out of the working capital facility and all. So those limits remain intact. This is an independent amount which is made available. So given these facts which are there, more particularly considering that the bank itself as part of the terms does not treat it as part of the overall borrowings, and given the fact that the receivable is not derecognized, it's not derecognized. It is derecognized only later when it is settled by adjusting these two. This amount should be treated only as other financial liabilities, and because of the short-term nature, it will come under current liabilities as other financial liabilities. So this is the conclusion of the committee, and it goes on to add that given the nature of arrangement, for a better understanding, adequate disclosures should be made of this particular amount appearing as liability. I'll just use this opportunity to highlight the other side of the transaction as far as the dealer's books is concerned. For those who are attending this webinar and interested, there's a proposed amendment to IAS 7, which is coming for trade finance, supplier finance arrangements. So in the books of the dealer, how would this get accounted, presented, disclosure? That's an amendment which is there. Since our query is only with reference to company, I'm not touching upon it, but I'm still drawing that reference so that those interested can look at that literature which is available. That's a proposed amendment which is there, and it's available both in our institute and the IASB website as well. So that's it. I have Shripal, and I look forward to hearing from Jain Bhai.
No, I think I have nothing to really add. It is, as you said, heavy on facts, very specific on principle. So nothing specific to add. You can, Sripal can have his own comments if he wishes to.
Thank you, Vijay sir, to summarize the facts very beautifully. The facts are a little heavy, right? So basically, what appears that this entire arrangement and the money received by the company from the bank appears to carry a transformational characteristics, right? It can eventually, in the event of the default, can transform into borrowing. But at the first instance, it is not cannot be treated as a borrowing. That's what coming out in the EAC, right? So I would again like to use this opportunity to highlight, which Jain sir has already mentioned earlier, that there could be many peripheral issues that may emanate out of this query. Whether the company was right in not recognizing the receivables, whether there would be any consideration for accounting of financial guarantee or not. So there could be many peripheral and incidental issues that would emerge out of it. But the committee confines to responding to the very specific queries that has been posed to it, right? So, and it would be very important to go through the section points considered by the committee, which is sort of contains a disclaimer as to what points the committee has considered and what points the committee has not considered, right? So basically, therefore, it is to be kept in mind that any opinion of the EAC serves as a guiding tool, but it should not be treated as sort of a commandment as such, covering all the situations, and should not be generalized as such, because the facts of each case could differ, right? So thank you, sir, for enlightening us on that aspect as well. Moving to the next issue, which is with respect to classification of PPE under, sorry, I just,
You're on the right slide.
okay. So the facts of the case are as under: the company is engaged in the manufacture of ammonia, urea, and complex fertilizers. The production units of the company consist of nitrogen, phosphorus, and potassium, NPK, in 3 streams. There's an NPK A train, B train, and C train. NPK A, B, and C trains of C company are not in operation from 2005. That is more than 15 years. Due to technical issues, non-availability of raw materials, and storage of manpower. Currently, they are not in immediate use condition due to technical obsolescence arising from the change in the production process. A major revamp expansion was carried out in 1998, enhancing the annual installed capacity of NPK trains. As per company's accounting policies, estimated useful life of plant and machinery is 25 years. Post revamp, the NPK A and B trains were used hardly for 7 years and therefore they become idle. Further, both the trains A and B were not in line for more than 15 years and were not in immediate use condition. Hence, until these trains were revived for usability, Board of Directors of the company proposed to reduce the installed capacity of NPK complex, taking into account only the train C which was in operation. The company has a plan of refurbishing the NPK A and B trains in order to bring the viability of the said trains. In the financial statements of the company for the year ended 31st March 2021, consequent to the board approval, the company has withdrawn the assets belonging to NPK A and B trains from the property, plant, and equipment with effect from 1st April 2020 and classified under capital work in progress (CWIP). The same will be reinducted to PPE once these are refurbished and in ready to use condition. Due to classification of the assets of NPK A and B train from PPE to CWIP, the company has ceased the depreciation of the said assets from 1st April 2020 onwards. The query is like this: whether the accounting treatment followed by the company with reference to classification from PPE to CWIP and cessation of depreciation is correct and in accordance with Ind AS. In case the accounting treatment followed by the company is correct, then how the presentation of CWIP is to be made in accordance with Schedule 3 to the Companies Act 2013, as amended by MCA notification dated 24th March 21. In case the assets are to be shown under PPE, whether impairment is to be recognized. So these are the 3 queries that have been posed by the queries. So I would request now Jain sir to deliberate on the same. Jain sir, please.
Sure. So I'll try and take this quickly because I am as eager to hear NPV on the last query also. So I'll try and keep it very brief. So looking at the broad issues that have been highlighted so well in the facts of the case, I would note down 2 or 3 points which are really the focal issues. One is that the train which is not been in use, A and B trains were not used for for the last 15 years or so, indicates the state of affairs so far as these trains are concerned. At the same time, the other important fact is that the board has clearly spelled out that they have a plan for refurbishing the said plant. It clearly shows that there is no intent to dispose of the entire plant that is there. It is valued at 2.2 crores as per the facts. Now, very quickly moving to what is the justification that has been given by the company in order to move that item or propose to move that item to capital work in progress. They have cited para 67 of AS 16. I'll mention that briefly. It is stated in the EAC opinion that the carrying amount of an item of plant and machinery, etc., shall be de-recognized either on disposal. Sorry?
This suppose I'll just give you this concept.
Hello?
Yeah, please continue, sir.
Yeah, okay. So shall be de-recognized either on disposal or where no future economic benefits are expected. Now, the logic of the moving to CWIP is that they believe that the plant and machinery has no economic value because it is not able to produce. For the last 15 years, it has not produced, and it requires significant refurbishment expenses in order to do that. Now, this is a case unlike some of the others where a very technical reading of the standard is very essential. And I would therefore rather, it is the same para 67, which is very, very clear that when do you de-recognize an asset of this nature? And that para 16 is, para 67 is absolutely clear on that aspect that you can de-recognize when no future economic benefits are expected from its use or disposal. Now, the fact that the board has said that they intend to refurbish and they are not treating the value as nil is clearly indicating that there is an economic value to it, and therefore the primary condition of de-recognizing a property plant equipment is not satisfied. Here, unlike in other cases where I said facts are there, here this is the case where the word of the standard is very critical. So, A, you cannot de-recognize it on that ground. Once you do not de-recognize that, then the concept that can it be treated as an asset held for sale also is ruled out because they are very clear in their decision that it cannot go under the meaning of Ind AS 105 where the assets are held for sale, because the board resolution itself says that it is going to be refurbished. So 105 goes out of the picture, so to say. Para 6 para 6 of 105 is saying that it can be treated as a non-current asset held for sale if there is certain conditions being satisfied. But there are two important conditions in that para itself, which I'm just touching upon. One is that if an asset is to be considered as held for sale, it must be available for immediate sale. You can't say that I am intending to sell it at some point in future. Then that is only a proposition, not a fact. And the other is that there must be a plan to sell the asset, which obviously is not there. So therefore, the EAC has looked at and considered that 105 cannot apply. Having said that, the third and last proposition that one would deal with is A, the conclusion is very apparent that you cannot de-recognize it from property plant equipment. You cannot move it to asset held for sale. Therefore, if you can't de-recognize it from PP, it cannot go into CWIP. The moment that conclusion is reached, the secondary conclusion that does depreciation have to be charged because there is no use for the last 15 years? Again, the answer is provided by the standard which says that, and EAC itself is listed out, that depreciation is because of efflux of time, technical or other obsolescence, other factors that arise, and therefore there is no exemption granted in the standard Ind AS 16 itself from charging depreciation, because it is very clear. Again, I'll read out the wording. Depreciation of asset ceases it can seize only at the earlier of the two dates that asset is classified as held for sale or from the date that it is derecognized. So in our case, neither of the two being possible, the only logical conclusion is that depreciation has to be charged. There is no option. Once you come to that conclusion, you have virtually answered the query in the sense that so far as you can't move it out of PP, you can't recognize it as held for sale. Therefore, you have to provide depreciation on it. All these answers are self-evident once you read that. And then finally, EAC has very rightly drawn attention to para 63 of Ind AS 16 itself, which draws attention to Ind AS 36, which provides for impairment. And they have very rightly pointed out that the fact that the asset has not been in use for nearly 15 years would indicate a prima facie evidence of impairment which needs to be checked. Now that obviously the auditor would do, and the EAC has stopped over there by answering the question in that manner. So to sum up, can't move from PP, can't treat as CWIP, must provide depreciation, and additionally must look for impairment, and that's a matter that is left to the company to decide. So I think I would stop there. Looking at the time, I'll not go into further detail. Thank you.
MP, sir, your thoughts on it?
Yeah, I just have one point in the interest of time. I think one point which could probably be added or evaluated is here for 15 years, the asset has not been in use, and they're very clearly stating the same. So the disclosures in the standard Ind AS 16 relating to assets which are not in active use, those disclosures are required. Probably you can draw reference to that as well, because that's also a very important point. So while it is not spelled here, because the focus goes off on why it is not CWAP and the fact that impairment should be considered. But I think also important is the plan of revival is futuristic, and at present it is an asset which is not in active use. So those disclosures, in my view, are important.
Very right. I had, of course, missed that point, but I fully agree, sir.
Yeah.
Agreed completely, sir.
Yeah.
So, sir, if we look at the facts, the queries had argued that no Ind AS has specifically mentioned any accounting treatment for transfer of PP to CV. But a committee felt that there is ample guidance available under Ind AS 16, whereby a PP can be moved out only on the two criteria. Once is the derecognition criteria is met, or a reclassification under Ind AS 105 is there. So none of the criteria were met, and the committee has opined accordingly that this cannot be moved out as such.
Yeah.
Right.
But I think, Shishir, just to give benefit of doubt, I think while it's been 8 years of Ind AS in India, it's still early days. So I think some of them, when they say there is no guidance, I think it's just they're evolving. I think we need to give that benefit of doubt to people.
No, in fact, they have referred to para 67, but perhaps it's not the right understanding of the para.
Correct.
So it's not as if they are not aware, but
Yeah.
there can be issues of interpretation, bona fide issues of interpretation at times. So one has to give benefit of the doubt to them, and they have been good enough to approach the EAC. I think that says it all.
Exactly. And for the benefit of all the members here, the Vice Chairman Piyush has joined the webinar.
So, Piyush, sir, I think we have run out of time. Do we have
Yeah.
time to cover last opinion? I think we should end here.
Perhaps
Yeah.
you can ask, without putting the facts, Sripal, you can ask MP Vijay Kumar to just give the conclusions. Because
Okay,
you can put up the facts on the screen and allow him to just give
Okay.
Yeah, please.
Yeah. With 3 minutes, I'll close it. So the last one is relating to a housing finance company where loans are given, and loans are all obviously secured on mortgages and all. If there is a default, there's a process under SARFAESI Act where you first repossess the asset and then go through a process where it gets auctioned. if nobody else is purchasing the asset, then you get to buy the asset and you hold it. So the query here is, at the time when you repossess the asset, because there's a default, should we treat it as an asset in books? And since there is an intent to eventually sell it off, should we apply Ind AS 105, non-current assets held for sale? The answer is, on the fact pattern, as part of the recovery process, when you repossess the asset, that particular asset is your collateral. It is not your asset. The borrower has the time under law to settle the due any time until the final auction is concluded. So consequently, the repossession of the asset does not warrant accounting it as a asset, whether it is 16 or whatever. And since you're holding it for sale, the question of 105 consequently also does not apply. So you bring the asset into books only when the auction process is completed and you become an owner. At that time, the asset comes into books. And as a company, you may choose to put it to your own use, or you may choose it to sell. If you choose it to put it to own use, it's a non-current asset. You apply Ind AS 16 or whatever accordingly. If you have chosen to sell, then evaluate whether the conditions of 105 are appropriate. So that's in a nutshell, this last opinion. So I think
I'll just add quickly,
please.
Just a word on that. Very simply put, because this issue has come up time and again, the mere act of repossession does not result in any entry in the books of accounts, is of course what even MP Vijay Kumar said. It is only subsequent actions and decisions by the committee, board, whatever, that may or may not result in books reflecting such actions. But at this stage, the repossession does not result in entry in the books.
Right. So over to you, Piyush sir.
Thank you very much, Shipalji. Thank you very much.
Piyush, I'll just
Yes,
take
MP sir.
1 second.
Yeah.
In fact, I want to thank the committee for the opportunity to be here, and season's greetings and wishes for a very happy new year to all the participants and the hosts, the EAC members and the staff. Thank you.
In the interest of time, I'll also just say I echo MP Vijay Kumar's thoughts and of course my gratitude for being here once again. It is a learning for all of us when we participate over here. So thank you for the opportunity. Thank you.
Thank you very much, MP Vijay Kumar sir. Thank you very much, Jayant bhai. Thank you very much, Shipalji. It was a wonderful session. Just for the information of all the participants, total 2,200 viewers were there. Wow. And it is one of the highest in when compared to all the seminars, webinars which we held under our committee, Expert Advisory Committee. And that speaks about the volume of the today's speakers. MP Vijay Kumar, again a senior Central Council member past. Jayant Gokhale was also a past Central Council member. Shripalji is a co-opted member of Expert Advisory Committee. And if you actually look into the topics which are also of a lot of interest to all the participants, I believe, accounting treatment of other income, accounting treatment of pre-project expenses, channel financing, timing of capitalization of PP. I think so it was a wonderful selection by both the faculties, and it has helped a lot to the participants in time to come. To all the participants, a very good evening to all of you. And I, as always, I tell in the concluding remarks, the Expert Advisory Committee for this year, we had started a series of such webinars, and I'm sure a lot of participants are watching continuously. And day by day, number of participants are also increasing. Idea behind doing this webinars was a lot of efforts goes when these opinions are prepared. It's I would just brief it up. When we receive an opinion, office actually does a preliminary study on that, and office prepares an opinion. Sometimes office takes help of the technical experts who are on the panel. If any of the participants would like to be part of this technical expert group who help us in drafting these opinions, I would request you, please write us to the Expert Advisory Committee email ID. And definitely we would like to consider, and we would like to have more and more technical experts to help us in drafting such opinions to respond to the queries which are received by the various corporates. Once these opinions are received by the office, a thread-based discussion happens at the committee level. The committee comprises of the various central council members who are again an experts in their individual fields, in the NBS, in the accounting standards, and also who are technically experts and who are involved, are co-opted in this. The co-opted members in this are the technical experts who have been contributing largely to such development of NDS. Whenever some study material happens, they are involved in that exercise, and they have been roped in as a co-opted member who untiringly sit for this committee meetings wherein one opinion is discussed for more than 2 hours, 3 hours. After 2 hours, 3 hours discussion, we do not conclude to the final conclusion. Again, it is sent back. Sometimes it gets deferred for 2 meetings, 3 meetings for reaching to an unanimous opinion. And that is the level of deliberation which has been done. When you read an opinion, you may get a fair idea, but actually you are not aware how much discussion has happened, what was the logic behind it, which went to this opinion, and therefore such webinars are happening. We have decided to do this webinar so that you get a logic behind it, how this conclusion was actually arrived at, why this conclusion was arrived at. And after such webinars, my request to all the participants is all those 5, I think so 5 or 6 we could briefly cover it. But all the 6 opinions which have been discussed, if you read today itself or tomorrow and or very sooner within 3, 4, 5 days, I think so clarity about that opinion would be much higher, much better now, because after listening the experts that how this opinion was drawn, what was the logic behind it, I think so it would be more experts. I know a lot of people, lot of participants would not be practicing on day-to-day on India's. But it is very important to look into the logic which has gone in forming an opinion. That will help you in interpreting accounting standards also. You may not be applying India's every point of time. All participants may not be using India's. They may not have a clients where an India's is applicable. But important is not applicability of a particular standard. Important is how it has been discussed, how it is interpreted, how it is applied to the real life situations. That will help you in discharging your audit and assurance functions more importantly. Of course, it is a December, my season's greeting to all the participants. And obviously, we have one more month. We'll try to come back with one more webinar in the month of January. 12th February, the new committee will be forming. A change of guard will happen. New committee will be formed. The same council is continuing, but the new committee would come. But whosoever joins the committee, whosoever is chairman, vice chair, I'm sure this type of webinars will be continued. And my special thanks once again to MP Vijay Kumar ji, Jain Gokhale ji, who have always been at forefront. Whenever we have asked, whenever we have requested, it takes a huge effort to present a webinar, especially on these opinions. It's not like a normal topic wherein you have been given a particular NDSU and you can go in and speak for 2 hours. Huge amount of research is required, even though they will be part of those opinions drafting. But again, it has to be read. Thank you very much, both of you faculty, for obliging EAC, for being there with EAC always. Shripal ji is a moderator for this wonderful session. Thank you very much for moderating well. Very difficult to moderate 2 stalwarts of Expert Advisory Committee and 2 stalwarts of our council. Very difficult, but you have done a wonderful. And also thank you for always being there, being a part of co-opted member. You are contributing a lot to this Expert Advisory Committee. Thank you very much once again to all the participants. Good evening. Have a good night. Have a good sleep and a good learning always. Thank you.
Thank you very much.
Thank you.
Thank you all.
Thank you. Tag team, please stop.